How would an S&P 500 portfolio work in retirement? Many investors nearing retirement feel comfortable staying fully invested in the S&P 500 because recent performance has been strong, but that confidence is often based on a short window of returns rather than the long-term reality of retirement. Retirement can last 20 to 30 years, and during that time, markets will go through multiple corrections and bear markets. Once withdrawals begin, even modest withdrawal rates can amplify losses and deplete a portfolio. The late 1990s provide a clear example when the S&P 500 produced annual returns in the 20 to 30% range for several years in a row, and many investors came to believe strong gains were easy and would continue. Then 2000 came. Someone withdrawing an inflation-adjusted 4% from an S&P 500 portfolio in 2000 saw the account fall to roughly half its value within just 3 years, meaning a retiree at 62 with $1 million was left with barely $500,000 by 65. For those who stayed invested after the Great Recession 9 years into retirement, by around age 71, the portfolio had lost close to 2/3 of its original value. At that point, the withdrawal needed to continue income was now 14%, up from the original 4%. Today, the S&P 500 sits near all-time highs and trades at historically elevated forward earnings multiples, mirroring the late 90s. While the index has delivered roughly 10% annual returns over the long term, those averages hide the danger of sequence of returns risk, where starting withdrawals before or during a downturn can permanently impair a portfolio and leave too little capital to fully recover, even when markets eventually rebound. I'm Harrison Johnson with Wilsey Asset Management. If you like these videos, be sure to give a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.